Good afternoon, everybody, and welcome to another fireside chat that we've got planned for this afternoon. Joining me today, we've got Sukran Mehta, who is the CFO of Docebo, and also in the background with us is Mike McCarthy, who is the company's IR Vice President. I will be your moderator for today's fireside chat. My name is Nick Agostino. I'm the Diversified Technology Analyst here at Laurentian Bank Securities. Before we get started, just a quick housekeeping item. Just for all the attendees, make sure that your microphone is on mute and your camera is turned off during this session. Please ensure your name appears on the screen so we can properly address you should you have a question. And when it comes to questions, feel free to use either the hand feature or submit your question through the chat, and we'll get to that question as soon as we can. And for everyone's knowledge, the questions will be moderated by Jordan Simon, who will also be handling any technical issues should they arise. So that said, we'll get started. And gentlemen, welcome to today's fireside chat.
Thanks for having us, Nick.
Thank you. So Sukran, this is a question I've asked a lot of SaaS companies today over the course of other fireside chats. I think it's one that is certainly worth asking of Docebo, and that is, now that we're 2 years into this pandemic, when you look at, when you assess what your customers, first of all, what have you learned about your customers? What have you learned about the marketplace that you did not know, going into the pandemic, when it comes to learning trends in general? And then when you look at your customers and the fact that economies are starting to reopen, travel is starting to happen, do you see your clients starting to go back to how things were pre-pandemic? Or do you think that the pandemic has drawn or pushed through an adoption for your solution? In other words, acted as a nice catalyst where those clients are saying, hey, there's a great cost savings associated with this type of solution adoption, and therefore it's only proven the value proposition made you guys that much more sticky. So your thoughts on that?
Yeah, good question, Nick. I think that what I would say is, at the outset, just for folks to know, Docebo is a learning management software company that solves for learning at any level. And I mean any level, from internal, external, and we're a horizontal platform. And when you think about it from that lens, what the last 2 years has done for us is really brought, historically the companies would have had, LMS or learning management software as a forward-looking companies that have always had a strategy on making sure their stakeholders were ahead of the curve in terms of learning. But what the last 2 years has done a couple of things. One, hybrid is here to stay. Number two, as you think about learning is, and our platform was never designed to be an internal use case. It was designed to be learning being pervasive. And that has become an essential strategy for every C-suite executive that is now not only in midst of the toughest labor market out there, but in where we sit today, or even in the past 2 years, having a hybrid strategy to address your customers, your suppliers, your frontline workers, your internal employees, your franchisees, etc., is an essential need for every business. And I think, we're not a Zoom type of business, which is a phenomenal company in its own right, which you can turn on overnight. It requires C-suite thought process and strategy and emphasis to then execute on a learning strategy across your multiple stakeholders. And what has happened in the past 2 years is that those stakeholders have got extremely focused on why learning is an essential need for, and I deliberately use the word stakeholders, because learning has always been thought through the lens of internal employees compliance jazz. We as a business, and this will help you understand maybe the last 2 years. In 2019, we had 50% of our business its use case was external/hybrid learning, meaning for revenue generating operations, for customer, supplier, vendor training, etc. And hybrid meaning both. They would use our platform for internal and external training. And so that's a revenue generating operations. But in the past 2 years, we're actually now 60% of our business is external/hybrid use case. So which is giving you a sense of how people have even moved forward, that even we have strengthened our business in that regard. The one other, I think the one other point that I think may be worth mentioning, Nick, what we see is that when you think about learning, people go into this platform. I used to be at PwC in my old days. I remember those days where you go tick and bash, do some exercise, but learning has evolved to a very different beast. It has to be individualized to the end user, whether it's your supplier, whether it's your customer, whether it's your internal employee. And products and services such as Docebo excel at doing that. You have a very different touch and feel when you go into a Docebo platform. And I'm going to give you an example. If you are AWS Customer Academy, the customer in AWS sees a very different touch and feel to the AWS internal employee who's doing a different type of training. And this is highly customizable. So the more you can make it individualized to the end user based on the use case, and then solve their learning needs through social learning, which is important, that's the kind of trend we're seeing accelerating. And I'm going to just say one thing. I was at a conference where ServiceNow CFO was speaking, and she made a specific point about how and this is one of many examples, they're increasing their learning budgets in the next fiscal year by 30% or so, which is a strategic move because it's a deflationary tool in this environment.
And so obviously, and you brought up some excellent points around, we always think about learning as being internal, but this is not just a tool to teach our own employees, it's to teach our customers' employees and build that network effect, if you will. So there is a nice multiplier there. But you also talked about it's a nice a way to fight inflation, which is the second part of the question is, there's obviously a good cost saving element to what you guys are able to bring to the forefront. We hear a lot of companies that are saving dollars today because people are working from home, but eventually they know they got to give some of that back. In your case, there would have been in-person interaction over the course of a year, and that would include food, travel, accommodations, what have you. I got to think that a lot of these companies are saying, instead of getting together 4 times a year, we will get together 2 times a year, and we will adopt the Docebo solution, not just to teach our own employees, but other people's employees. And from that perspective, there is a sticky cost savings to counter the inflation argument. How important is that cost saving discussion as far as the adoption that you're seeing for your solution, and that's helping drive the stickiness? Is it all about the network effect, or is it all about the cost savings, or is it a combination of both? And if you have an example where you can quantify maybe cost savings that even one customer might have seen as a result of what they're paying for Docebo versus the cost savings that they're going to realize, that'd be great too.
Yeah, absolutely. One of the things I would start with, Nick, that I think cost saving is a really important element, and I'll come to that in a second. But if you think about the 60% of the use case in our business is external hybrid training, a lot of these businesses and customers are using our platform as a delivery mechanism of their content to generate not only in some cases, and a lot of cases, they use us to generate revenue. And in some cases, it's a critical part of their business model to sustain that customer. To, let's say you have a customer academy at AWS. And actually, this is an example maybe which will help you. AWS has 2 platforms with us as an example. One is called the Customer Academy paid version, and one is the non-paid version. The paid version is going live this year as an example. And what that means is AWS is using the Customer Academy not only to retain and manage those customer base, but also to expand that book of business from a top line perspective. So it's not the value proposition doesn't in the external hybrid use case doesn't just talk about the cost saving, but it also increases top line revenue growth. The other example I'll give you, which I can speak to, let's just call it's a franchisee business. We can't name it, but it's one of the ones that has 24,000 restaurant chains in the world, and they effectively implemented this the Docebo in all of their restaurants. Well, they started one of the chains in 2 years ago or so, and what they did was they measured what happened to their franchise, each franchisee post implementation of their learning program using Docebo. And what they found was there's a direct correlation between the implementation of their learning strategy to revenue per store going up. And once we have tools, I can speak to other products, but I won't if we speak further, but we have tools that help customers to not only optimize the cost, but also to manage, hey, if I implement Docebo and my learning strategy, what happens to my revenue object in Salesforce, as an example, and you can directly track that integration between those two. But to answer your question on the cost side too, it is the most cost-effective way. It's probably one of the most low-cost investments for a business today to manage attrition or to engage employees and retain employees and manage attrition. And I think that anybody you were, I'm sure, talked to in the panel today has spoken to what, especially in the tech sector, it's one of the most craziest markets we're sitting in from a labor shortage or competitiveness perspective. So it's a very low cost investment, and the value proposition when you think about the cost versus top line growth of a company, it's I think every company is looking through both lenses to kind of, and it becomes a very easy conversation when you think about it from that lens.
No, that is great color. I think when investors think about an LMS tool in general, they always think of a traditional HR tool, and they think of it on the cost side of the business within the internal organization. And what you've basically said is Docebo is training not just internally but externally. As we all know, it acts as a sales tool, and it's also going to benefit your income statement as well. So it's got a three-pronged as opposed to a single prong with traditional tools. That is great color. So the next question is, according to Fortune Business Insights, the global LMS market is projected to grow at about a 19% CAGR from 2021 to 2028. So when we look at your current business model, I mean, you guys are growing, lights out as far as I'm concerned. Sales growth of north of 60%, I think, in the last couple of quarters, and your EBITDA is getting close to that break even. So obviously, we live in a world now where investor sentiment has kind of shifted more from top line to more of a balance between sales growth and EBITDA margin. So as you get closer and closer to break even and go beyond that, help us understand as we look out into the medium long term, what is that right balance that you are driving the business towards when it comes to sales growth versus EBITDA margin? And then I know you guys are continuing to build a bigger and bigger SI ecosystem. So maybe talk to what influence those partners as you keep adding them, how they're going to impact your top line, and how they're equally going to help you impact your margins.
Yeah, no, absolutely. And Nick, I think you've followed us enough. So one thing I'll remind folks is Claudio Arbaugh, our CEO. I call him funny enough, I call him a wartime CEO in a sense that I call him the Italian Frank Slootman, because he's always managed the company. And the word I will use is growth at the right cost. What I mean by that is burn rate matters, free cash flow matters. And we've always, and if you look at our matrix, a couple of numbers that will help you understand this, we burned $14 or $13 million of cash since inception to generate $118 million in ARR. And our unit economics in terms of CAC ratio, we spend $1 in sales and marketing to generate $1 in annual recurring revenue, which without taking into account LTV to CAC, I have 80% of my deals are 3-year contracts. So this gives you a sense of unit economics being one of the most efficient in the industry. We have, we've always managed the business to grow as fast as we can, as responsibly as we can. I spoke about the fact that this is not a business where you just turn on the light and it goes up like, boom, like a DocuSign or a Zoom. And then, there's differences. There's a implementation, sales cycle, implementation cycle. It's a thought through process. And so we grew 50% or so in 2019, 55% or so in 2020, and 60% or so, as you mentioned, in 2021, is a reflection of what I talked about earlier, as well as our execution of our strategy. As we think through the future, we will continue to invest in the business to grow as fast as we responsibly can. But I've kind of spoken about this, so I can kind of speak to the fact that the business, with its growth trajectory and its operating leverage, will naturally get to free cash flow and EBITDA as we exit 2022. And that math is pretty straightforward, without doing anything to our business, because we're not a business right now which had to do any changes and pivot because the market had a different view. We viewed that business always from that lens. And so we naturally get to free cash flow EBITDA positive as we exit 2022. But we were always close to that. We were always EBITDA free cash flow neutral, very close to that number. And we accelerated some of our investments on a 3-year cycle basis. But as I look to the future, we are continued to be, as Claudia would do it, we are very, very much mindful of how we allocate our capital. And I'm happy to I didn't go into the growth. I don't want to, we're not compromising anything on the growth side to make this happen. It's just getting there naturally. And I'm happy to kind of give you a sense of how we think about growth and the pillars of growth over the next 3 years.
Yeah, I'm just curious if we were looking out 3 to 5 years and giving that natural, let's say even 5 years, as you come up the curve, if you will, in terms of EBITDA and profitability and all that stuff, free cash flow, and now we say, hey, let's look out 5 years. What do you think is that normalized organic growth rate / EBITDA margin? Have you guys given that any thought? If you ask me, I can give you a number and you tell me if you agree or disagree.
I can say this. Let me just, I'll say a couple of points. Hopefully that'll help. We don't give guidance, at least for now, but I can speak to, let me speak to growth drivers, and I'll kind of give you a sense of how we think about it over long term. There's really, to simplify, there's like 4 or 5 pillars I think about in my growth drivers, which will each play its course over the next 3 to 5 years. Some play together, some play slightly later, or whatever. Number one, as I talked about, 60% of my business is external use case, hybrid use case. That's a total addressable market no one's ever defined today. If you look at the LMS space, it's a simple multiplication of number of enterprise customers versus number of internal training. That's not a TAM. That CAGR of, I think, 19% is not really what is driving the business. That's why we're growing at a higher rate. And so to the extent that we continue to invest and help our customers on end-to-end learning needs, we have an opportunity that we can define ourselves. Number 2, we talked about the new products and modules. I have a book of business of 2,800 customers. We have really just launched those products in the last 3 months or 6 months. And as we move into the next cycle, I have enough opportunity to continue to increase my net retention ratio, which was 113% last year. And we should continue to expand that book of business. Number 3, geographically, North America is our sweet spot, will always remain our sweet spot. It grew 70% last year, but we've now matured there as an engine, and we are also looking at other geographies like Australia, like Germany. And I think over time, Germany should become our second biggest market outside of the US. And we've just started in Germany. It's literally just grounds up from 2 quarters ago. And number 4, I think the one that I didn't highlight at the outset, 50% of the business is now coming from enterprise book of customers. That's customers over $100,000 ACV to anywhere to $1 million ACV. That's almost half my ARR, very different to 2 years ago. And to the extent that we can land and continue to expand into the Fortune 1000, the Fortune 500s of this world, we see a lot of opportunity ahead. And that's just initial, right? ACV. What you don't see is what happens to that customer post we land them. So we have enough engines of growth, and I didn't talk about OEM, to continue to go forward. I think that to the extent that we can manage and just keep our heads down and execute, we will always manage this company to grow as fast as we can, keeping in mind that we're well aware, we have the rule of 60 or rule of 40, but let's say rule of 40, that we have enough levers to maintain as we look through the future the rule of 40, whether we get there through growth or we get there through free cash flow and EBITDA, we are very mindful of that too.
Yeah, no, that's a great answer. I will say, kind of lead into my little bit into my next question. The one thing that I remember when I first started looking at Docebo that strike me as like, wow, when you look at the rate of organic growth, and I can't emphasize that enough to people, organic growth, and it's all being driven by inbound activity for the most part. OEMs are part of the equation, but in my opinion, you've got two levers that are just about to get pulled. The OEM side, I think, is early days, and I know we agree on that. And then you highlighted earlier around the CAC. When I look at that ratio, it's been coming. I mean, first of all, it's one of the industry leading numbers as far as I can see. It has been trending down towards the 1 times. So you were getting better leverage before, but can you just confirm for me, is that because you guys have been spending more and more on building out that outbound sales force? And so as those guys start to get more and more traction, we could quite possibly see your CAC start to go back, well above 1 as it has been historically. In other words, the downward dip is a reflection of the investment on the outbound ahead of the payback. Is that a fair comment?
Yeah, that's a good point. So yeah, I mean, one thing, if in full transparency to this audience, when I joined this company, I couldn't believe the inbound to outbound ratio. It was like 90-10 at the time, and it was when I talk about that, I my predecessor Ian, I said, Ian, this is unbelievable, because which effectively is telling you the customer's already there. So that seller better land that deal because the customer's already convinced. And so over time, what we have done is we have built, to your point, and now that maturity is showing up in that outbound or I also call it self-source, because great companies like Salesforce, what Benioff had done is made sure those sellers are well capable of not only just outbound but self-sourcing deals. They're hungry for it, and that engine has matured as we built the specifically, I would say, the we call it the enterprise segment, which is $100,000 ACV and above. And we've invested and matured that organization, which is showing in the results in the past couple of quarters, where almost half my ARR is coming from that segment of the customer. And the other thing that probably is an unspoken story in that CAC number is when you get to a certain level, Nick, what you have to do is, so Alessio has been running this organization, but as you grow as an organization, you need to have the right leadership in the SVPs and VPs that support him as we move into the next layer. And we've made some really good investments. We've just had some couple of great leaders start in the past quarter or so, that kind of investment is necessary at this point in time. That gives you leverage, operating leverage in the future. So to answer your question in terms of numbers, I'm pretty comfortable around that $1 ratio. I mean, whether it's a plus or minus 10%, it doesn't make a huge difference. I do look at that closely as well as burn rate closely. And I think I'm comfortable. There's been obviously wage pressure, which is, even with that, I'm pretty comfortable with the 1-to-1 ratio, because I would say companies which are heavily in inbound are going to see huge inflation from a lead gen perspective. I expect Google is going to print a phenomenal quarter, by the way, based on what's happening on the lead gen space. Anyone who's totally reliant on search is going to see quite a bit of incremental cost. But we've done a nice job of pivoting that to outbound and self-source, and to the extent that we continue to balance that, I'm relatively comfortable in those levels of $1 CAC.
Yeah, that's great color. I guess we are reaching the out of time, but I do want to get one quick question in. So consider this a speed round question.
Sure.
Very simply, obviously you guys are going through a big new module launch cycle, right, on the Learning Suite side. Maybe can you set the table in 1 minute or less of new products or new technologies that Docebo is contemplating that you look to deliver as part of that next cycle?
Yeah. Firstly, I'd say we've launched a bunch of products, as 5 or 6 last year. So we'll continue to, we want to make sure we mature that. We are very mindful of getting the LMS right in the first place and helping our customers solve their content, performance measurement, Docebo Connect, over time. We don't want to overload the customer.
Right.
But when you think about the future, I will say there's areas and opportunities within. We continue to excel in external use case. So customer education, sales enablement is an area we invest in heavily, and we will continue to do that and make sure we're top best in class there. Content is an area we see a lot of opportunities in, not necessarily in the game of creating content, but enabling content, because
Right.
we have 2,800 customers. It's a very different margin profile business. We're an 80% margin profile. So when you create content, it's a very, it's not anywhere near that. And then just a bit of snippet. I think video and audio in general, in terms of learning, is an interesting area, and we'll see some technologies that may advance us there too. I'll just leave it at that. But there's some things we'll do over time there.
Well, that is great color. So yeah, as I said, we've come to the end of this this fireside chat. Sukran, I thank you for your time. Mike, as always, I thank you for your presence. Guys, job well done. And to all the attendees, I also thank you guys for joining us. And so we'll wrap it up there. And just a quick reminder that we've got E-Ink presenting at 2:40, so in about 8 to 10 minutes. So thanks, everybody.